Blog Talk Radio.
Good morning. I'm Brian Dooley, CPA. It's a great morning in Orange County, California, and today on Tax Talk, we're talking about the unique but solid legal tax planning of using your tax haven corporation with what's known as a private annuity agreement to virtually eliminate investment income. And I have a co-host, and as all of you know who listen to the show, I am a big fan of the virtual world, the world of the unseen. And I'm going to get Rob the robot and see how he is doing. Rob, how are you?
Brian, I am feeling fine. Thank you.
That is great. So, a tax haven corporation in this example is what's known as a controlled foreign corporation, and that simply means you control it. For the most part, the client, the businessman, the investor owns all the stock either himself or through a family estate planning trust. Both ways work great. For this is income tax planning, and we're not going to be really talking about the estate and gift tax or asset protection in this episode. We will in a few weeks. So we're going to really not differentiate which party owns the shares of stock. And the very first step in all this is to get a definition of a private annuity. And let me see if Rob can find something for me.
Sorry, Brian. I was out late last night. Okay. Let me start my Google search. Yes. Investopedia explains this. Definition of private annuity: an agreement between two parties in which one party, the annuitant, transfers an asset to another party, the obligor, in return for unsecured payments for the remainder of the annuitant's life. For the agreement to be classified as a private annuity, neither party can be in the business of selling annuities, that is, neither party can be an insurance company. Brian, Investopedia goes on to say, tax benefits of the asset transfer are the major benefit of this type of agreement. In most cases, a private annuity is used to transfer assets to a family member where normal transfer would be subject to gift or estate taxes. The private annuity effectively makes the transfer a sale, thus removing high gift and estate taxes that would come with a simple asset transfer. The interest rate that is used for calculating the payments on the annuity is determined by IRS. Once this rate is set, it cannot be changed.
Rob, that is perfect. Thank you very much. So, important features to look at this is that it's between people not insurance company, and generally it's between you and a trust. You've set up for estate planning. Sometimes if you have responsible children, it's directly with them. And it would work something like this for estate planning. You want to take assets out of your taxable estate. You want to reduce your net worth. You're getting a little bit older, or maybe you're worried about a spouse also getting older, and you have a responsible son, somebody like me, a CPA with a master's degree in taxation. And so you would transfer to that responsible son, let's say $1 million, and the son would go to the IRS table, look at the equation, and the IRS would determine how much you get paid each year based upon your life expectancy. If it's two of you, there's a table for joint lives. And then every month, the IRS looks at the government cost of borrowing, and here comes a big loophole. The government looks at the IRS looks at the government cost of borrowing, and that cost determines the interest rate factor used on the annuity. Now, with the Great Recession, we have what's known as a loophole. And when I use the term loophole, it means a legal way of saving taxes. The loophole is the government cost of borrowing has plummeted because the government's printing money trying to get us going. So historically, the rate has been on a private annuity for the interest factor has been around 6%. Now it's 1%. So this is going to be an important math factor in our equation. But before we get to the equation, let's find some information on how the income is taxed on the private annuity. So in my example, I would be paying a monthly payment or an annual payment, however I would like to design it, to my parents, and they are going to have to pay some income tax on that. So let's get a explanation from Rob here.
Yes. I have my notes. The law is found in Section 72. The law applies to both commercial annuities and private annuities. A part of each payment received is a tax-free return of your investment in the contract. This part of each periodic payment is excluded from income. In other words, this part is tax-free. To determine the part of each payment excluded from income, each payment is multiplied by the exclusion ratio. In general, the exclusion ratio is calculated by dividing the taxpayer's investment in the contract as of the annuity starting date by the expected return as of such date. Any excess is included in taxable income. Brian, here is an example. Doug has a tax haven corporation. He is age 63. He transfers $120,000 to his corporation. His corporation promises to pay him an annuity for the rest of his life. The agreement follows the IRS rules on private annuity in Section 7520. Under the IRS rules, the annuity is $7,000 per year and only $1,300 is taxable income. Doug Corporation invests the $120,000. He is a great but cautious investor. He makes 6% on his money. This is $7,200 a year. The corporation net income is $200 as follows. The investment income of $7,200 minus the annuity expense of $7,000.
Well, that is a fantastic result. And as you look at this, you can see that Doug can live a long time. And the IRS uses the census's life expectancy. We take a census in America every 10 years. And in this example, Doug's life expectancy was about 20 years. Now, if Doug lives to be age 110, the corporation will keep making payments to Doug until it runs out of money. Now, this is Doug's corporation, so it's really his own money. If Doug should die the next year in a car accident, then the corporation is still his and it passed to his heirs. The annuity stops at the time of his death. So it's quite a tax advantage. And this tax advantage has not always existed. It's only this last few years. And this is what happened. There was a tax court case. Now, in the United States, we have two types of tax laws. We have those written in the statute, and we have those created by court cases, and that's called common law. The United States has a common law just like the United Kingdom. We inherited that concept of law from the UK, and it is very strong in the United States. The KPMG partners who went to jail because they violated a common law. So a common law is just as strong as a statute. Quite often, when it's by a high court like the Supreme Court, it is stronger than the statute. The Supreme Court overrides any written tax law. So we have one case, and I asked Rob to find that. Rob, can you find that recent case?
Okay. I found a recent IRS tax court victory. In this case, the Judge Halpern ruled that payments are a private annuity reduces a tax haven corporation earnings. The IRS won the case because the payments were accrued but not paid. The name of the case is Dante and Sandy Perrano, Petitioners versus Commissioner of Internal Revenue. But, Brian, I do not think this blog talk will make the IRS happy. This is a huge tax advantage. As you know, in a few months, the new 4% excise tax is applied to investment income. Using this approach, Doug avoids both income tax and the excise tax.
Rob, you're right. And we have a lot of listeners on this, and I wouldn't be surprised if one of them would be in the tax writing committee. And what's unique about this law is that it follows every IRS rule. So let's kind of look under the hood of this engine, and I'm going to bore you for about 2 minutes with some tax terms, just in case you want to pass this blog talk on to your CPA. So a corporation has two types of income. One is taxable income, and that's what it pays income tax on. The other is called earnings and profits, a lot like taxable income, and that's how the tax law determines when a corporation pays a dividend, if it's a taxable dividend or not. Controlled foreign corporations and tax havens are a little bit different because they don't have U.S. taxable income, unless by chance they had an office here or a business here. But when they're doing work outside the country or merely investments, they do not have taxable income. So the kind of income they have is earnings and profits. And without earnings and profits, the income of a controlled foreign corporation is not taxed to the U.S. shareholder. In the example here, Doug's tax haven corporation had $200 of earnings and profits. So when the court case defines when a private annuity can reduce earnings and profits, and in that case, when you read it, you'll see that it is when it's paid. That's what creates part of the loophole. The other part of the loophole is the low interest rates on a private annuity, the rate being 1%. If the rate was 10%, then a big portion of what Doug received each year would be taxable income. So if you're going to use this tax strategy, you really want to use it in the near future, 6 months or a year. An important aspect of a tax strategy is creating a blueprint, much like you would if you were going to build an office building. And as you know, one of my goals is to not only have you save taxes, but to have a tax strategy that allows you to create wealth. And when you have a solid blueprint, you really know how to use the tools. It's kind of like building your car. To get the best out of your car, you want it to be designed well so it can take you wherever you want to go. Same with a tax strategy. So as most of you know, we get for all of our clients a tax agreement from the IRS, and this is known as a private letter ruling. So if any of you would like to brainstorm that with me, then of course give me a call at 949-939-3414. Now, we want to kind of go on to some of the other tax advantages here. And I don't really think the tax court really knew what was going on here.
Brian, I do not understand. Are you saying that the judge created a new loophole and that the IRS agreed?
Yes, that's what I'm saying. the IRS really disliked this taxpayer so much that it just wanted a victory without thinking of the long-term consequences. Because one of the disadvantages of investing in foreign mutual funds, foreign investment funds, which a lot of people want to do if they want to diverse their currency or diverse their economic investments, is that they have a penalty tax on a law called Passive Foreign Investment Company. And these rules do not apply when you make the investment through a controlled foreign corporation. So not only are you saving taxes, you have once again a car that can take you where you could otherwise not go. It's kind of like getting a great SUV. Now you want to go off-road a little bit, okay? You want to be in some foreign funds, some safe funds. Vanguard has a big office in Dublin where they have some really safe international funds. And there's other people like that. Maybe a iFund for gold. There's a lot of great funds out there. And those funds are not open to Americans for the most part because of this new FACTA bill that you have probably heard about that takes effect strongly in another 3 months, and it escalates to such a point. So this is the kind of a method that allows you to create wealth by going into some great investments. So now I want to kind of wrap this up by just passing on one of the other advantages, which we'll get to, and that is asset protection. If the foreign corporation is owned by a trust, and I generally put my trust in Nevada, this structure creates a great asset protection with really small additional compliance costs. Now, the Controlled Foreign Corporation will file the Form 5471 each year, giving the IRS all this information. And these filing choices should be seen as a tax planning opportunity where you get to lay out your blueprint and get the best possible tax result. Well, that is it for Tax Talk today. I look forward to hearing from any of you, and Tax Talk will be next week. I will be on the road, so next week will be a unique program. Until then, I wish you the best in your tax planning.